Hey, good afternoon, guys. We had a very flat session. Volatility was low, but not sold off or anything. It was between the one and the two, actually, on each of the instruments, the VIX, SPX, and ES. But we were inside the one on all instruments, everything, the YM, Russell, NQ, all of it. Here's the NQ, just the same. Just a very flat trading session today. And largely that had to do with the monthly one holding the risk line going into the tariff negotiation with China. And President Trump just tweeted out another tweet, sort of, razzing them, saying 80 points, like it's an arbitrary number or something. So, dropped it down from 145 to 80, so he's cutting it in half. I guess he's making a concession, right? Um, so almost half. It's funny. I mean, they'll make a lot of headway. I'm thinking they'll come with a resolution this weekend. They're flying, to Switzerland to get it done. So hopefully there'll be some more positive news and we can get the market above that monthly level. What I would like to do is take a moment and share some higher time frame charts. I want to put one more chart up. Hang on one second, and then I'll pull this over and we'll take a look at some higher time frame charts. And I would like to talk to you about using the open and the close to time your trade, right? So here's the daily. You can see that we were just, trading flat inside the daily range. Um, Earlier in the week, we did basically the same. We've just basically stayed inside the daily range all week. Got a, little bit above it yesterday, but they sent it right back down. And the weekly, let me change this to the ES. Here we go. Give this a second to generate. So we have an open and a close, and we put the mean, the middle of the distribution at the open or the prior close. We can do both. So we can calculate on the close and the open. The point range for your PT2 oscillator, you can take the point range and also run the distribution from the current day high and low. And we'll talk about that too. But you can see here for this weekly range, we're just inside the weekly one. And in fact, the 7-day or the 1 week, our weekly calcs are the number of trade days in the week. Our monthly calcs, number of trade days in the month. Quarterly calcs, number of trade days in the quarter versus a defined calendar day, 20-day, 25-day, 30-day, whatever you would like to model. I just stay with the standard 30-day. Some people like to use 20 or 25. Um, but I have found that the dealer really likes the 30-day, so that's why I like to put it up. But if you would like to run 25-day risk reversals, you can certainly change it to a 25-day. Or if you like a shorter time period, a 20-day, if you like the hedge fund, the um, maybe a 10-day 100, something like that, you can certainly do that. And those make really good distributions, by the way. 10, 100, you can get some really good ideas for how the hedge funds are situated in the market. They like to do that. But you see here that the weekly ones are often used for support resistance. And here it went right from the 1 to the 2. I mean, it's just textbook 1 to 2. And the solid lines are the open, and the dashed lines are the close. So there's that spread between the open and the close for the week, right? So you can see that this gapped up over the weekly close to the weekly open, came back and tested the weekly close. Look at that. And then went back up. And where did it go? To the 3 of the weekly open. Um, I can't tell if it's a 7-day or a week. I need to make the distinction between calendar and days and trade days. Find some solution for that so that we can understand, maybe dash dots or calendar days. Maybe that would work. Um, and that way we can still see the open and close for that. I might try that. And then the regular solid lines are for the trade days. In fact, I'll get that done this weekend. But the weekly chart is a really good um, strategy to use for determining if you want to be delta neutral inside or outside the range. And how we do that is I like to use the daily distribution. Okay, it's going to look a little bit bigger bars, but you can see it still, adheres to the daily one. You can put the you know what else you can do? Let me do this for you. You can put a second distribution on the chart. So we can put up a daily on the second one, but go back and put the 60-minute on the first one and split the distribution up. I need to put this 500 days for the okay. So now when I put the PT2 indicator on the chart, because I put the daily below it, I can choose the input series to the daily, change this to day 1, and add a second one. I'm going to load one that I've already got pre-selected. It just puts the 1 period line on it. And I'm going to put that on 3. Then when I restore my chart to arrange all, I can move this up, move up, minimize this. And now you can see I have a daily distribution on the 60-minute chart. And just at a glance, I can see, in fact, I could turn this into a horizontal line if I want. So I can just see the current location instead of the past locations. So instead of a line, you can make it horizontal. And there you go. So now we see that the market, what did I do? There it is. The daily is 35.7125 and 99.50. And the daily range is in between the 1 and the 2, and on the low end of the 1. So you can see that we're very low. If we move out to a period where price goes further out, um, we can change this. We can add another distribution to the chart, a weekly. Put this in panel 2. And so that we can tell that it's the weekly 1, 2, 3, we can change the colors to like all deep pink, and that way it'll stand out to us that we're looking at the weekly 1, 2, or 3. And now we can tell where the daily R-vol is in relation to not only the daily 2, but the weekly 2 right here. So a little bit elevated. And over here, you can see that it's way outside. Where did it go? Right here. I need to make this not a bar, but I mean not a horizontal line. I need to go ahead and make it a regular line so we can see this. Oops. There we go. So here you can see that it went up to the weekly 2 outside the daily 1, the daily 3, outside the daily 3 to the weekly 2. Here we're outside the daily 3. You see all that? We're outside the daily 3, and here we went to the weekly 3. And it went over. See? It went over, and you went over. So you can tell where you are with a point range to match the chart. And that helps you if you're going to be trading strangles or selling premium. If you're inside the distribution, you're going to be selling your risk on the outside of those ones. But if it crosses above the 2, you're gonna move your risk out. You can either hedge like the pros do, keep your condor or something like that if it's the volatility's low, like the VIX is below 20 or something, and you start crossing above the 2, you could just delta hedge it to the 2 or something like that and then take the trade off. Um, or move the risk out. You could decide what to do because you can control the volatility. It's easier to look at this when you use a daily bar. Let me put it back on a daily bar so you can see a big difference. But it is workable to see it on the 60 minute. I wanted to show you that. But like right here, now you can see it much easier. You can see how the daily interacts between the daily 1 and the 2. And you see how the volatility's been crushed coming down, going into the end of the week, and how big the volatility got outside the range during that tariff tantrum. But otherwise, the volatility, really respects these weekly levels. And so it's really set up to help you sell premium or, trade to target and make those decisions whether the vol is, outside, more favorable for call spreads and put spreads, or inside, more favorable for short strangles or condors. Here's that monthly. And as I mentioned to you, we've got, the monthly ones have been sat on by the dealer for good reason. They don't want to move their risk out over the weekend going into trade negotiations, but can certainly, move it up to 58.45 before the end of the month on a good trade result. The quarterly has plenty of room to move to the upside. Takes just a few more minutes because I'm, streaming while I'm trying to load the chart. Give it 1 second. There we go. So you can see I have, 57.67 and 58.31, and we've got 56.50 as our quarterly support. It's moved up. It's shifted higher. So 57.50 and 57.67, 57.70. So, and then 58.31, and we have 58.45. So this 58.31, you see right here how much that was respected. It's an institutional level. And also, you can use these for the tails. We do allow you, here's a quarterly tail, to come in and place extensions of the underlying distribution and carry it outside the 3. And that gives you that, flexibility for skew that you need, um, that your Black-Scholes model doesn't have with your deltas. I mean, you can take a delta to 0, but it really helps to see the R vol with the HVAL to know when you're going to be projecting to go out. Here was 1.5 times. Here's a 6 month. So um, how far out you need to take it, and you can figure out the point range and use your premium. I mean, if you're using your at the money strike, we want to be drawing that um, level for your break evens on the chart and comparing those to the realized and historical volatility levels. So you can get your implied volatility levels from the settlement or the current volatility, implied volatility, and measure those against the Jats PT levels as well. Um, and realize that the implied volatility is supposed to be further out, right? You don't really want to see implied volatility levels inside the Jats PT levels. That would show you that there is something about to change, maybe with the market. Whenever the implied vol goes inside the realized, implied is supposed to be a premium. You can sell the premium and rely on it to be outside where the realized volatility is going to be trading. Theoretically, it doesn't always work like that. So I have seen instances where the implied vol is inside the R vol, and it still went to the R vol. It just blew right through the implied vol. So sometimes I guess it doesn't matter where implied is. They still trade to the R vol or H vol. But the implied vol are very much respected. I mean, don't get me wrong. You have, quite a few traders trading the implied volatility because they don't have R levels, right? They would be trading them if they had them, but that's why we need to get the indicator out. So the more people recognizing these levels and trading them, the more they'll be respected or used in the market for structural support. So, but the spreads, I can show you a spread chart um, with just the threes and the tails. And I think this is very helpful for you to see where to position your trades around, and you can see the spread between the open and the close better on this chart. Um, so you can see here that it was non-existent. They were the same. And here you had a much wider spread. And so even on this monthly distribution, you can tell that the market a lot of the times will, adhere to these levels. Um, so you have 30-day, 1 month, and let's add 4 week. Because this will give you an extra dimension. So right away you can see that the 4 week catches price. Look at that. So now it's starting to make sense, right? So you can see how the dealer comes in and uses these time distributions. That's what they're trading. They're trading time and price. and put the 4-week on the open. So if you're trying to project, where your end of the month implied volatility are, or your theta, or whatever you're looking at for the end of the month, and you want to see where the threes are, your edges that the market, likes to tag and trade to so often at the end of the month, that is the target. It's either going to be in the middle or at the end, um, a lot of the times. This is a great tool to be able to do that. And plus, like I said, you can put different distributions up on the chart so you can model, daily, weekly, monthly volatility levels that the daily R ball will trade to. And it trades to these levels over and over and over. I mean, there is a reason to have, you know, um, 30-day or 1 month volatility on, the PT2s with a 1-day R vol, because the 1-day R vol, if it goes outside the standard daily distribution, like right here, where we saw earlier on the weekly, it went outside. It usually trades up to a monthly level. Look, 1, 2, 3, 4, touches that monthly level and comes back in. And look at this upper one up here. It never got touched, for months and months and months. A 7-day. That 7-day 3, that's your dealer risk line. I mean, here, look, it went right up to it and pulled back. You got one outside touch right here in December, but all year so far, well, except for this April tariff tantrum. But you can see how they use this 7-day 3 as their main bread and butter monthly or daily 7-day range. The daily range rarely will hit a 7-day 3. There, got it out. And then here you can see here it is a 7-day 2. So you can mix your time and see how consistently these day excursions, or put up a weekly bar, and see the weekly bar trade to the monthly levels. So, we can, look at the right side. These are thresholds. These are actual point ranges. So like right now, you can see that we're inside the ones. This looks like it's the 7-day 1. So we're trading inside 7-day 1. That's low volatility. We're trading inside the daily 3 and the 7-day 1. This bottom one is the 1-week one, or the 1-week 14 HVAL. So you'll get used to using these thresholds to model your strategies, because this is pure volatility. And if volatility, pierces, say this, 2, and tags the 3 of your weekly 3, not the 7-day, you're going to be looking for that volatility to start collapsing and coming back in. So if you trade volatility, you can be trading, the pushes outside the weekly 3, and maybe trade a strategy that trace it back inside, but or just trade to the level and let your trade off if you're a futures trader trading to target. Or otherwise, like if this April is an anomaly, um, be be aware that the outside tails do attract the algos. Um, it doesn't go outside to the um, monthly 1.5 very often. In fact, that was the only one. Um, it's rare, and that's why it's respected. Here's another one. It was closer in, but look, it's the same thing. It's the same concept. That's 1.5 times the monthly range, and they're there, the bank algos. So I'm glad you get to see this. See, it went outside the range and came down to your 1.5 time, and then it went back inside. So if you can time your trades, if you're long the market, to pick up a trade when here it walked that band, but, realize that this is where you can make significant money in the market, because if you can, pick up a 500-point trade from timing the lower, 4-week 3 up to the upper monthly 3, I mean, that was a hell of a trade. The coast to coasts, as I call them, from the bottom to the top, or top to the bottom. Whenever you see me play that song, low, high, high, low, that's what we're doing, is we're talking about those coast to coast trades. And it could be on many different time frames. I just throw the song up. Nobody knows which time frame I'm looking at. I just, I love that song, and it gives me inspiration to, shoot for the other side. Usually it's an intraday time period for me, but if you can, find a touch on one of these outside levels, and you've got a confidence, it's so hard to step into these trades first. Let me tell you, you've got everything on your monitor going red, 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 and you're the only one on Twitter or whatever saying buy the F and dip. And people think that you're an idiot, but you're the one with the volatility indicator realizing, well, this is the monthly 1.5 monthly range. In fact, you'll see me do that. You'll see me post these BFD memes when everybody's, looking for the sky to fall. And it's very hard stepping into these. I guarantee you. It takes, a lot of patience and skill. You may not want to trade the line. You may want to wait for like a 60-minute bar to turn around, or, whatever time frame you like your confirmation on before you step into it, to give yourself some, cushion to have something to trade next to. Having a confirmation bar um, to help you, position into a trade is not a bad idea. Um, you know, it gives you a stop to put your, risk behind, and give your trade a chance to work itself up. But these spreads work on all time frames: quarterly, weekly, monthly, or you can just look at the chart, the 1, 2, 3. And if you're in low volatility, it's going to stay inside the ones, especially with that VIX. We can put the VIX up, and know really well what the ES, the SPX, and the market is going to do. because if you're inside the ones, you're going to be, you know, doing the same thing. We're inside the one all week. See how it stays inside the one? Or, excuse me, you can go outside the one to the three or the tails, and they'll hit these levels and respect them as structure, as support, resistance. Look here at the three. These are daily levels. Here were some tails. This was at April. And I was able to stack distributions on top of themselves. So this is, like Six Sigma move. So I had to, go outside. So it's more than just 2 times the range. It's actually 6 times the range that the market trades up to. So in these outside moves, but they come back to these, prior levels a lot, and algos will, come in. Like here was that upper three. So I color code it to try to help myself see where I'm at. The orange are threes, the twos are blues, and ones are white. I try to put that on all my charts. I will go back and try to make a calendar day, the dash dot, so that we can have the difference between the open and close being the dash and the solid, but the dash dot for calendar days versus the solid for trade days. Okay, that'll work. I'll get that done this weekend. So when you put the VIX together with your strategy, if it's inside the ones and the VIX, you're not going to be looking to go outside. And I look for my monitor right here all the time, all day long. I want to know where I'm at, where my H fall is in relation to my R ball, because this really is the magic sauce. I mean, it really, really is. I knew right away today that we were early on, that we were in a 50-point range for the day, and it stayed there. My R ball did not move all day. We stayed inside that 50-point range. And that makes sense on a Friday. They weren't going to sell the market off, even though we could have gotten down to the max pain. In fact, my strategy called for it to go down to the max pain, but it would have had to have left the daily ones. And so when I realized that my max pain was below my daily one, I knew it wasn't going to happen. So the daily ones are instrumental. You would have to break below the daily one on the VIX to get there on the ES. And even though 21 was my monthly line, that to me is the monthly support. So I think that we're almost at monthly support, 21 or 2025 at the very bottom. But 21 is your 30-day one. 30-day three. I'm sorry, I'm looking right at the line. It's orange. 30-day three, 21. So that is for the VIX, the way they calculate the VIX, a pretty strong level. And it will get a lot of interest and GEX on that by the time we get down there. 22 was the high volume today. And I told someone that the level was actually 21, not 22, and showed him, and he was impressed because you could have seen that the high volume today was on 22, but it went right through it like it wasn't there. And then they stalled it out right here at the 2164. There was your risk line. And so they were probably running that spread today between 20 and 21 and 2164. So having your own volatility indicator is fantastic. You can put this on NinjaTrader. I run the live stream, so you do get to see the oscillator levels during the trade session and the chart. So if you like, if you don't have NinjaTrader and you'd like to know where the levels are, just as an eyeball, you can pull it up on your web browser. It'll be on a private YouTube, and you can check it during the day. There's no commentary or anything during the day. It's not like an entertainment channel. Um, that irritates me to no end, where people will just, force conversation or something, or try to guess where the market's going to go without having a volatility indicator, because it really is just pure speculation and not a very solid trade plan. You have to know where the volatility is to be able to trade in these markets, in my opinion. And that, even with that, you could still have plenty of room to mess it up. And believe me, if the higher the VIX gets and the wider the market gets, you can have the direction right and still get knocked out of your trade all the time. Um, but having a volatility indicator, hopefully, we can adhere to a strategy and set our risk. It's so important, and not just jump in, um, you know, indiscriminately, or try to sell strength. For instance, a lot of the times we'll have a bias and we'll think that we need to sell every resistance line in strength, when the market is showing strength. And that's, I'm guilty of that. I can raise my hand on that. Um, so, every mistake in the book I have made. So, it is a learning process, learning to, navigate a small account is not the easiest thing to do in the world. So I feel your pain. It's much easier to trade a daily chart if you can afford the risk, and safer, um, because you can afford to time your trades and get behind a bigger move and be more successful. Intraday trading can be very noisy. Trying to hold risk, like today, where it's just, wrapping itself over non-directionally inside the one. So, with that said, I hope you understand the variance trading model, uh, and going outside the threes to the tails, and having, the R vol versus H vol placement to see where you are inside the distribution, to know whether you even want to consider a trade above or below support or resistance level. And with that, I will let you go. I hope y'all have a great Mother's Day. Have a good weekend, and we'll see you on Monday. For my subscribers, we can have a training class Saturday. So I'll see you in the room tomorrow. Thank you.